That brings us to our talk of the tape. How believable is this bounce coming after one of the quicker 10% corrections on record and just ahead of a Federal Reserve meeting as risks flare up on both sides of the Fed mandate? Let's ask our panel. Chris Heise is CIO at Merrill and Bank of America Private Bank. Courtney Garcia is Senior Wealth Advisor at Payne Capital Management. And Jordan Jackson is Global Market Strategist at J.P. Morgan. Courtney, a CNBC contributor. Welcome to you all. Chris, let's set this up here. I guess to know if maybe the correction has run its course, you might have to have some idea of what the correction was pricing in and reacting to and what the market's been contending with and whether we have some clues as to whether it's lifting.
Part of it's seasonal. Yeah. We've seen a lot of this, both in the economic data, plus what goes on structure in the market-wise, et cetera. You had a lot of sell programs hit. If you're into the day-to-day activities, the tape of the day, a lot of sell programs hit for obvious reasons, a lot of uncertainty, et cetera. But then there's always a high noise to signal ratio. Soft data versus the hard data. And all this is coalescing in the last 4 to 6 weeks or so. The high-valued parts of the market obviously taking the hit. They're the big overhang. They're the anchor that brought it down. But that's what creates bargains for the areas that had nothing to do with anything of the uncertainty, whether it's tariffs or other things. So, we were out there thinking that in the next week or so, last week, you would get the selling exhausted. But it still needs a catalyst. It still needs confirmation that the biggest worry, which is growth, is really not going to unfold. And that's kind of where we are right now.
And we're in that moment of figuring out if growth is going to hold up or not? Yeah.
Yeah, I think you got to start with the consumer first and foremost. You have to watch the consumer trends. It's still the engine. And, we have 69 to 70 million households at the bank. We have very good data around the consumer, still stable. A lot of this is seasonal. You do get that so-called, let me look for something cheaper. Let me look at that replacement of where I'm going to spend my money. And then as you get into the spring, you get further away from the bad weather as well. We think that trend actually starts to tick back up again and provide some of that confirmation that the consumer's okay.
Courtney, part of what we are dealing with is, I think, elevated expectations among investors coming into the year, along with those higher valuations. And so the question right now is if this has been mostly positioning and the rate of change of growth in the economy has gone down, and maybe first quarter earnings are getting cut, 10% at the index level, gone down 2 PE points in the S&P over that time. Either it creates an opportunity or it presents a warning. How are you thinking about it?
I think this is more of an opportunity, and I think a lot of this downturn has been sentiment-driven, and I think the fact that this market has gone down so quickly on much more just sentiment being negative, much more so than the data actually reflecting that thus far, I think goes to show that. And you just got the investor sentiment surveys. Bearishness levels are close to 60%, and the highest that's been is 70% at like the worst of the 08-09 recession, right? So I think, barring some really big downturn, I don't know how much worse the sentiment can go, and that really, I think, leads to a buying opportunity. And it's not all of the markets that have gone down. About 95% of this downturn has been because of the Mag 7. You're seeing a lot of other areas are actually holding up better. Like even today, you're seeing China's continuing to do well. Europe has been outperforming the U.S. Healthcare has actually been holding up. There's a lot of places where, as a diversified investor, you've actually been able to be more insulated here. But I think you want to take advantage of this as a buying opportunity more than anything else.
Jordan, I mentioned that, Friday and today were both days when there happened to be very few incremental headlines on tariff plans or a lot of the other initiatives that have been thrown out there by the administration that whatever the details are, ultimately, the market is taking them as potentially short-term drags on growth, even if they lead to a good outcome. So how are you thinking about the interplay between policy, making a best guess as to where it lands, and then how the markets are priced for it?
It's been really interesting. I think the markets are trying to find sort of this Trump put. I don't think it's really out there. It seems the administration has a very high pain threshold. And, the truth is I fully anticipate that we are going to get some sort of round of tariffs come into play on April 2nd. And so I think we're probably at best looking at a bit of a choppy sideways market. We could see some further downside. But again, this isn't a growth scare in my view just yet. Right. And so I think sort of the further downside is sort of minimal. I think we're closer to the bottom and we could start to catch a bit of bid on days like Friday and days like today. So I do think we got to be a little bit careful here. Certainly a market would I'd be, dollar cost averaging into some of the more unloved parts of the market that haven't kept up with the big tech trade over the last couple of years. But I think we have to be careful. Again, there seems to be a pretty high pain threshold that the current administration is willing to accept.